Good morning. I'm Will Beck, Wholesale Marketing Rep for Sprague Energy.
And I'm Kristyn Schweitzer, Director of Sales for the Northeast. Welcome to Sprague's Refined Products Review, where we offer you insights into what we're seeing, hearing, and talking about daily. Today is Friday, March 28th.
On today's special feature, Kristyn and I are going to review and discuss Sprague's forward contract programs. Kristyn, could you start us off by explaining what contracts are?
Sure. The term contract refers to a lot, but in this case, what we're talking about is risk management tools that Sprague can offer our customers who sell refined products. Our contracts are wet gallon supply agreements where our customers are the buyer and Sprague is the seller. These contracts are programs used to lock in pricing, terminal location, product, volume, and terms. They're an obligation for our customers to buy from Sprague and an obligation for Sprague to sell to our customers. In the event of any type of market tightness or supply issue, Sprague would protect a contract gallon. We have great programs to manage risk, and to determine what program is the best fit, we would first ask our customers what they're trying to do.
Kristyn, what sort of questions should a customer be asking themselves as they're considering buying forward contracts?
Customers first need to decide what they're hedging. Are they hedging a ratable supply gallon for their own use? Are they hedging a price or program offer to a homeowner or one of their customers? Are they just trying to protect themselves from basis, which is the spread between New York and their local rack, by locking in a differential? Regardless of what the end goal is, we have a program that'll effectively meet all those needs, securing future prices, managing costs and market uncertainty, and securing supply.
No one knows what the market's going to do, but how does Sprague look at the forward markets?
Sprague's look at the forward market is evolving by the day, the week, the month, depending on whatever it is that's driving the market and impacting it. When we build a forward market, Sprague is making an educated assumption based on our supply and traders' outlook on the forward market and products. Forward pricing quotes are comprised of similar components to our prompt and rack pricing, with that one significant exception, Sprague's forward market assumptions. To quote our customers anything beyond today, we have to determine where we think the market will be at that time. These assumptions can vary greatly from one supplier to another.
When should people be looking to secure gallons? Is there a best time to buy?
Well, the reason why we're having this conversation right now, Will, is because we've just put our forward offers out on Sprague Real-Time. We can generally trade up to 18 months forward, depending on the market and the location, and customers can layer and contract throughout the year. From a timing standpoint, if we knew the best time to buy, we wouldn't be sitting here together in snowy cold Portsmouth. We would likely be on a beach somewhere warm. However, this goes back to customers knowing what risk they're trying to protect and what they're trying to do. If dealers are offering customers a fixed or cap price program, for example, they would want to have a sale on the back of a purchase. Locking a customer into their gallons at the same time as securing the supply with your wholesale dealer is a hedge and protects margin. If dealers are looking to secure supply, the ideal timing to be locking in any type of contract would be when they're planning, building their budgets, and looking ahead to next year. It should be noted that there's risk associated with all risk management programs. That's why they're called such. Sprague would certainly discourage any kind of speculation, and we recommend buying and selling in as tight a window as possible for our customers. Customers should always know and fully quantify the potential outcomes of any hedge, whichever way the market moves.
Now that a dealer has decided that one of Sprague's forward programs is for them, let's discuss different program offers we have. The simplest program Sprague offers is a fixed forward, a NYMEX-based program that secures a terminal, product, price, and gallon amount to be lifted at a later date, for example, January 2026. This helps fit the fuel volume and pricing needs for your customers and reduces pricing risk. Forwards are available year-round for heating oil, diesel, and kerosene. One unique term to keep in mind is that fixed forwards are available from the 10th through the 9th of the following month. Contract increments are 42,000 gallons, but these fixed forwards can be locked in for as little as 1,000 gallons per month. As mentioned, fixed forwards are available on real time, so you have the convenience of a quote at your fingertips.
Thanks, Will. That's pretty straightforward. A heat curve is another popular program that a lot of our dealers participate in. Can you explain how those are different from fixed forwards?
A heat curve is like a fixed forward, but our dealers can buy the way they are selling, securing one average price for a strip over the winter. Less in the shoulder months, more in the peak months. This allows our dealers maximum flexibility at the time as they are keeping the fuel purchase simple with one strip cost. And we have multiple strip options: October to April, November to March, September to May. I'm certain we can customize a heat curve that meets our customers' needs. Customers can lock in contract increments starting at a minimum of 126,000 gallons or as few as 1,000 gallons over a strip. This is customizable in 100-gallon increments, essentially designing a program price to one customer at a time. Our monthly volume allocations are degree day weighted on a 30-year average. Heat curve gallons are also available earlier in the month and are lifted from the first to the last day of that month. All heat curve options are available and customizable on Sprague Real-Time. Those two programs we just talked about protect from a rising price. What program should a Sprague customer be interested in if they want to protect to the downside as well?
Sprague offers a physical cap, aka our fizz cap, which is essentially a heat curve with downside protection. Like a heat curve, customers choose a winter strip and they get one cap price for the entire lifting term. But a physical cap, for a premium, allows participation in any downside gain. A customer never pays more than their cap price, but they can potentially realize downside lift for lift gain.
Can you explain lift for lift gain and how that might be different than if someone had just bought straight paper from a broker?
Sprague's physical cap is a great fit and program for dealers that are offering their customers a cap program. And they realize downside lift for lift because our system knows whether the cap price or the current market price is lower and bills them the lesser. Therefore, they realize the gain on the date they delivered the gallon. There are many options available to our customers to hedge their risk. Customers can work with brokers to manage their risk and cover their programs and protect their prices with paper or financial tools. However, often when working with paper, you're reconciling on monthly averages and say that the month starts down 20 cents and ends up 30 cents. We've all seen the market behave that volatilely. Additionally, by the time those reconciliations and averages are calculated, you could be well into the following month, not realizing any potential gain or payment, and you're generally paying your wholesale suppliers in 10 days for the most part. So the paper also does not secure a wet gallon of supply. Our deals are always a contract for the physical gallon, in addition to the pricing protection. So these are just a couple of benefits to Sprague contract programs and the Sprague physical cap versus doing paper with a broker.
I think that can really make a big difference for some of our customers. Let's look at the details and some of the finer points of the fizz cap.
Customers have to separately buy the downside protection. There's a premium associated with a physical cap. It can be paid up front at the time of contracting or spread out, financed, billed as lifted. Customers can customize their protection levels and be at the money or out of the money. There's a higher contract minimum requirement for physical cap deals of 10,000 gallons. Like heat curves, these gallons are available the first to the last of the month. And in the event the gallons are not lifted, they go away and there's a potential underlift penalty. Fizz cap deals can only be done by calling the contract desk. Please do not buy a heat curve on Sprague Real-Time and call in asking for downside. Customers can discuss in detail with their sales rep how the day-to-day lifts would realize potential gain and how invoices will reconcile to be sure that they understand how the program works.
We've been mostly talking about heating oil so far. What if a customer wanted to have downside on a diesel contract?
Then we would be talking about price flex. Price flex is like our physical cap with few exceptions. For example, it can be done for any term. The volume minimum is still a 10,000 gallon requirement. However, that can be 5,000 gallons in May and 5,000 gallons in July. The Price Flex contract program can also be done for diesel, where the physical cap is primarily designed for a heating oil sale. Instead of unlifted gallons going away, Price Flex gallons would convert to a fixed forward, however, any potential gain would not be realized. A reminder, FizCap and Price Flex deals can only be done by calling Sprague's contract desk. Sprague has a few other programs that our dealers can take advantage of as well. An index deal and unpriced gallon differentials. These are different from the risk management programs that we've covered so far.
Different, but very useful in their own way. Let's start with UGDs. Sprague offers an unpriced guaranteed differential contract, aka a UGD. And these can be used to secure supply. You are able to optimize your pricing decisions and base them on current market conditions. A UGD fixes a differential over the NYMEX for the period of delivery and can be only done in contract increments of 42,000 gallons. The base price can be locked in at a later time, either before or during the month of delivery. If you have multiple contracts, they can each be priced at different times in 42,000 gallon increments.
So Will, how does a customer price the gallons if they're unpriced?
The differential customers lock in is versus the NYMEX, so it's based on current market conditions. Customers can call in and trigger a UGD with us at any time. Like a fixed forward gallon, they get lifted from the 10th to the 9th, so if you price a contract on the 1st of the month, it won't be available until the 10th. If you price a contract on the 20th of the month, it still has to be lifted by the 9th of the following month. An index deal is unpriced as well, but very different from a UGD. Could you explain an index deal to us?
An index deal also fixes a differential and can be used to secure supply. It's a generally competitive way to lift a daily rack gallon. Customers really want to understand what an index deal type is and what it is not, and they can do so by talking to their Sprague sales rep. Index deals are based on a reporting company's daily posted benchmark. The two benchmarking companies are Platts and Argus. Sprague is an Argus shop, and we mark our daily inventory and sales to Argus New York Harbor, generally. Argus is different than NYMEX. NYMEX pricing represents the price of a gallon or barrel of oil in the future. Argus represents the price of a gallon wet in New York Harbor in a barge today. Argus deals secure supply, and gallons are expected to be lifted ratably. Argus deals can be for a winter strip or terms of 12 months, and monthly volume is predetermined. We can do Argus deals for any product, including gasoline, which is notable because we do not do any other forward contract type for gasoline. Sprague offers a volume tolerance, generally plus or minus 10%, and in gross gallon markets, there is a monthly shrink calculation. Again, those details can be reviewed in greater detail with a Sprague sales rep or the Sprague contract desk.
Where other programs we've been talking about offer a fixed component, an index deal changes every day, correct?
Correct.
Does that guarantee the low of the day then?
I only wish I could guarantee the low of any day. While Argus deals are generally competitive to the rack, Argus pricing does not guarantee the low of the day. It's generally favorable pricing, but it's a supply contract and not a fixed price. It moves with the market every day. Certainly, in extremely oversupplied warm winter, you could see rack differentials lower. And conversely, in a very cold winter or supply tightness, Argus deals do protect against regional basis or a spike at the regional rack.
What else should our customers know about contracts?
All of the programs we've discussed require credit approval. Most of our customers already have a credit line with us, but if a customer is interested in forwards, they should contact the contract desk or discuss with their sales rep to get that process started. It's also important to know that all of our contracts fall into a hierarchy. When you lift, our system will first look to see if there are any prompt contracts in place. Then it would lift against heat curves or physical cap deals in order of their negotiation date, and then it would load against any price flex, fixed forward, or UGD deals, also based on their negotiation date. Please keep in mind that fixed forward deals and UGDs are only available to lift from the 10th to the 9th. Once all contract obligations have been lifted, your lifts will default back to rack. If you have an Argus deal, you can be set up with a separate PIN unique for that contract to lift those gallons ratably without interfering with any other contract program. Lastly, customers can call the contract desk at 888-440-4944 from 9 a.m. to 3 p.m. for updated forward quotes or to discuss any of these contract types and deals further. Someone will be there to support you, as well as your dedicated sales representative. Talk to them about what you want to do and what your customers are asking you for. I'm sure that we can find a program or customize something that's the right fit.
Well, I think that just about covers it. Thanks for sitting down with me to discuss this.
Thank you, Will.
And thank you for joining us. We hope you learned something and that you feel more comfortable now with Sprague and our forward programs. Call the pricing desk or your sales rep at any time to discuss these programs and how they can help you better serve your customers. Looking ahead, our next feature will cover Sprague's marine fuel offerings and will be released Friday, April 25th. We'll be back this Wednesday, April 2nd, with another Refined Products review. Refine your insight, fuel your success.